Hi. What I want to do now is to introduce the regulation addressing financial instruments generally, and this is contained in four accounting standards at the moment: IFRS 7 and 9, IAS 32 and 39. The reason for this is that we're transitioning from two older standards, IAS 32 and 39, into two newer standards, IFRS 7 and 9. So there's a transition process going on. And we have the issues of disclosure addressed in 7 and recognition and measurement addressed in 9. So it's a bit complicated, and it's not helped by the fact that we have disclosure and recognition and measurement being split across two standards. It probably means that you need to consider these standards collectively. If we start off by looking at the objective of these standards, we can see that in IFRS 7, paragraph 1, it identifies the objective of the standard as ensuring that we have sufficient disclosures to enable users to evaluate the significance of financial instruments and the nature and extent of the risks of financial instruments. In IFRS 9, reflecting the changed focus onto recognition and measurement, we see in paragraph 1.1, we see that the objective of the standard is to establish the principles for reporting financial assets and financial liabilities. In other words, recognition and measurement. The scope of the standard is actually quite broad, and we can see this in the first instance in IFRS 7, paragraph 3, where we see that it addresses all types of financial instruments except for interests in subsidiaries, associates and joint ventures, employee rights and obligations, insurance contracts, and share-based payments. The reason for this is that these are all addressed in their own separate regulations. In IFRS 9, we see something very similar, where we see in paragraph 2.1 that the standard addresses all types of financial instruments, except for essentially the same list as above, plus leases. Again, because it's addressed by its own standard. We also see in paragraph 2.2 a linkage to another standard, and it needs to be understood that financial instruments, financial assets, can be created as a consequence of IFRS 15 revenue from customers in situations where we have deferred payment, and in these circumstances those financial assets are subject to impairment. The application, or the broad application of the standard, is clearly identified in these definitions. These are at this stage included largely in IAS 32, and if we look at the definition of a financial asset, it's quite obviously going to be cash, an equity instrument in another entity, and a right to receive cash. So quite obviously it's going to include everything from cash and accounts receivable through to an investment in a corporate bond. So the definition is incredibly broad, and it's going to capture most things in financial statements except those which are addressed in other accounting standards. It's very difficult to avoid. We see a similar approach with the definition of a financial liability, and it's generally defined as the obligation to deliver cash. So the implication of this is that if you're going to have to make a payment in the future of cash, then it's going to be a liability. So if you have a redeemable preference share, there's going to be an obligation to deliver cash, it's a liability. If you have a unit trust and the investment of the unit holder in the trust is repayable, then that is a liability, not equity. So for a trust, they're going to have no equity, it's going to be all liability, and because the payments to liability holders are interest, they're going to have no income, no profit or loss either. So it's a bit tricky, this definition, and it does highlight that we have a very, very wide view of a liability and a very, very narrow view of equity. The definition of a derivative has been shifted across to IFRS 9, and the definition of a derivative is incredibly broad, and it basically says that a derivative is something whose value is defined having regard to something else. That is incredibly broad, and so it's very, very difficult to have any kind of financial instrument which is problematic, which doesn't actually meet this definition. So that's a challenge that I think people are going to struggle with trying to avoid over the years to come. It's almost bulletproof. There are, however, some challenges. For example, you may have financial instruments which are hybrids or combinations. In relation to financial assets, these are regarded in their entirety. So if you have an investment in a convertible note, then it has both a principal interest type security and an option to purchase equity. They'll be accounted for on a combined basis. However, for things that are not assets, which I suppose that means equity and liabilities at the end of the day, these are to be separately accounted for. In other words, they're going to be cut up and they need to be accounted for separately. They would be allocated on the basis of their relative values, standalone values. In terms of initial recognition, this is pretty standard and it's addressed in 3.1.1, and it tells us that we recognise a financial asset or a financial liability in the statements when the party becomes party to a contract. Now, this might be done on the date of the trade, or it might be done on the date of the settlement of the transaction. This is because we can enter into derivatives or financial assets sometimes with a trade date or a settlement date, which might be a day or two later in terms of the market rules. If you're going to adopt one or the other, you need to be consistent. That's the key issue. The disclosure requirements are quite extensive, and these are addressed quite obviously in IFRS 7. And the key issue here is that they are focused on identifying or disclosing risk, and hence they are primarily focused on derivatives. That's probably not surprising given that most of the problems have been in the area of derivatives.